Today, we're going over a new addition to Tradelocker's risk calculator, the trailing stop. If you're unfamiliar with the concept of a trailing stop, the quick and dirty explanation is that it's a type of stop loss order that automatically adjusts when price goes in your favor. Trailing stops can be useful for traders looking to ride out as much of a directional move as possible, but depending on how tight your trail is, you could get stopped out early. First things first, let's find a trade idea and plot it with the position tool. Here on the 5-minute, price has been pretty parabolically bullish all day long. We can find some points of interest though, looking for the imbalances that haven't been filled yet. Here's a recent imbalance that we can use, as well as some up here. It's kind of small, but it's definitely there. And it looks like that's what price kind of returned to here. So let's hop down on the 1 minute now, and we get a better look at exactly what price did. So price came down to this imbalance, created a double bottom, and it's now engulfing out of the previous lower high that it created or tried to create during this bearish retracement. So with this type of price action, we could be looking to go bullish in this situation. So now we would come over and first plot a position tool. We can place the low down below the imbalance from the 5-minute, and we can place the take profit, say up at 2R. Now we can take our risk calculator. We'd be looking to place a buy order. We're going to set a stop loss. We'll drag our stop loss down to where the stop loss is on the position tool. We'll set a trailing stop loss, and we can trail it for a dollar amount or a percentage as long as we click this risk button. So we'll choose a dollar amount here, and we'll say we'll trail it for $50, okay? And our take profit, we'll place up here at our take profit zone at the end of this candle here, and we click buy. So now as you'll see, as price starts to go in our favor, the stop loss moves automatically to trail it, okay? So the more that price goes up, the more the stop loss goes up. And what this does effectively is protect any capital that we make on the way once the stop loss moves past our entry point. So again, once our stop loss, which started down here, moves up past here, then any profits we get past there are essentially locked in on the way up to the eventual take profit. So again, how you would do that is you would open up the risk calculator, come into buy, click the stop loss, make sure you click trail, you click risk down here, and then you would set the P&L or the balance, or how much percentage of the account you're willing to risk, and then you would just drag your initial stop loss to where you want it to be. If there are any questions, please let me know down in the comments, and I hope this was helpful.